Okay, let's dive into this. Today, we're looking at a truly unprecedented policy shift coming right out of Southeast Asia. So the Indonesian government, under President Prabowo Subianto, has formally approved this massive 40-year subsidized homeownership mortgage scheme. It's an incredibly aggressive, unorthodox intervention in the residential real estate market, and it's all aimed at solving an acute national housing shortage. Throughout this explainer, we're going to break down exactly how this financial engineering works, the big economic hopes driving it, and of course, the very real systemic risks it introduces.
Here's our roadmap for today. We'll start off with a 3 million homes plan. Then we'll look at the actual math of 40-year terms, explore what we're calling the demographic paradox, analyze the macroeconomic ripple effect, and finally wrap up with some lessons from global precedents.
Section 1. The 3 million homes plan, or President Prabowo's ambitious housing directive. So, to really understand the why behind a 40-year mortgage, you have to grasp the sheer scale of the problem: 12.7 million units. Just think about that number for a second. That staggering figure is the estimated housing backlog in Indonesia right now. Escalating property valuations, super strict supply constraints, and basically stagnant real wage growth have heavily marginalized millennials and Gen Z. Millions of young workers are effectively, they're just priced out of formal home ownership, leaving them stuck in substandard or informal rental markets.
But to the government, housing isn't just about providing shelter. It's viewed as this absolutely critical multi-pronged intervention. On the public health side, moving people out of high-density, unsanitary, informal housing is seen as key to eradicating stunting and mitigating respiratory diseases like tuberculosis. And on the economic side, the state is actively reforming regulations to attract foreign direct investment to fund these massive developments. They're aiming to use this construction boom as the primary engine to drive an exceptionally ambitious 8% annual GDP growth.
Section 2. The math of 40 years, or solving the monthly affordability crisis. Now, what's really interesting about this is the sheer contrast between historical norms and this radical new approach. Traditionally, subsidized lending in Indonesia capped out at around 15 to 20 years. But this proposed scheme, it stretches that to 4 entire decades. It's a massive leap in financial engineering, and it's designed with one primary goal in mind: creating immediate, day-one affordability.
Let's look at the real-world relief this actually provides. By stretching out that amortization schedule, a standard subsidized landed house that would cost roughly 1.4 million rupiah a month on a 15-year term plummets to somewhere between 800,000 and 900,000 rupiah on a 40-year term. And that drop to sub 1 million levels? That's highly intentional. It's designed specifically to capture unbanked, lower-income households who are earning just 2.4 to 3 million rupiah a month. For these hardworking families, this math literally dictates the difference between having a secure roof of their own or remaining indefinitely trapped in the informal housing sector.
But you might be wondering, how on earth do you keep payments predictable for 4 decades in a developing economy? Well, the state guarantees a flat 5% interest rate for the entire 40-year duration. To anchor this in a global environment of monetary tightening, the government utilizes state-backed entities like BP Tapera and the Housing Financing Liquidity Facility to blend cheap government funds with commercial bank funds. So this apparatus subsidizes the cost so that 5% rate can be smoothly passed directly down to the consumer.
Section 3. The demographic paradox, or the catch in the calendar.
Okay, here is where economic observers have flagged a pretty severe complication. Let's trace this timeline. Standard banking regulations require borrowers to pay off their debt before they retire and transition to a fixed pension, right? Well, in Indonesia, the private sector typically enforces retirement around age 55. If a university grad enters the workforce and gets a 40-year mortgage at age 25, that loan doesn't mature until they are 65. That's 10 full years after they stop earning a salary. To clear a 40-year mortgage by age 55, a borrower would theoretically need to take out the loan at age 15. This chronological absurdity means the policy heavily relies on credit life insurance to pay out upon the borrower's death, or it inevitably forces intergenerational debt right onto their kids.
And mathematically speaking, there's a profound wealth-eroding mechanic at play here too. Because early payments on ultra-long mortgages are almost entirely interest, borrowers build equity at a practically glacial pace. Critics point out that over 40-80 months, a borrower might pay upwards of 3 times the property's original purchase price just in interest. If they have to sell in the first 15 years, they're going to walk away with virtually zero accumulated wealth. This is exactly why some economists argue this is more of an illusion of ownership. It acts effectively as a heavily subsidized, highly rigid long-term rental.
Section 4. The macroeconomic ripple effect. Balancing multipliers and systemic risks.
Let's zoom out from the consumer for a minute to look at the massive economic stimulus this represents. The Indonesian economy relies heavily on real estate, which contributes between 14.6% and 16.3% to the national GDP. Academic estimates actually suggest that every $1 invested in residential housing can increase overall GDP by roughly $3. Pumping leveraged, subsidized demand into the market basically guarantees robust order books for developers and local contractors, perfectly aligning with the government's aggressive growth targets.
Let's move to the next point and see how this builds into systemic risk for the banking sector. Commercial banks rely on something called maturity transformation, meaning they take short-term retail deposits from everyday citizens and lend that money out long-term. But the average duration of bank deposits in Indonesia is usually less than 1 year. Handing out a 40-year asset severely exacerbates this liquidity mismatch. State banks like BTN will have to rely on massive securitization, bundling these mortgages and selling them to institutional investors, just to keep enough cash on hand to keep lending out money.
Furthermore, there is the subprime threat to consider. To accelerate loan origination, regulators have relaxed credit history requirements and allowed down payments as low as just 1%. But if an economic shock hits and housing prices stagnate, borrowers could quickly face negative equity, meaning they owe more than the house is even worth. Because they put almost no money down and haven't built any equity, the financial incentive for a distressed borrower to simply walk away from a 40-year commitment is remarkably high.
Section 5. Lessons from global precedents. Japan, Sweden, and the UK.
Globally, we see some fascinating comparisons. In Japan, 50-year loans are gaining traction due to skyrocketing urban real estate and demographic decline. However, Japan utilizes a highly integrated credit life insurance system to shield families if the borrower passes away, and they apply strict age caps. Meanwhile, over in the United Kingdom, 40-year terms are now commercially offered to first-time buyers. But in the UK, they're largely viewed as temporary stepping stones to secure a property with the expectation of refinancing later on. Even so, British regulators share the fear that this shifts standard lending dangerously into later life lending.
And this brilliantly illustrates what happens when ultra-long terms go unchecked. Just look at Sweden's trajectory. Prior to 2016, Sweden had literally no legal limits on mortgage durations. Borrowers strategized to minimize monthly payments, which resulted in an astonishing national average mortgage term of, wait for it, 140 years. Nearly a third of borrowers were paying only interest, accumulating zero equity. The debt crisis became so severe that in 2016, the Swedish government had to forcefully intervene, legally capping terms at 105 years and mandating strict principal amortization to force households to deleverage.
Which leaves us with this final, absolutely crucial question to ponder. Will Indonesia's 40-year mortgage create a generation of empowered homeowners or a generation of permanent debtors? In the short term, this policy will absolutely put keys in the hands of millions of young people and trigger a massive surge in construction and investment. But the unyielding math of a 40-decade loan, the incredibly slow wealth accumulation, the massive interest payments, and the systemic vulnerabilities introduced to the state budget and banking sector, makes this a really high-stakes gamble. The true success won't be known by how many loans are signed today, but by the financial resilience of the Indonesian people 30 or 40 years from now. I hope this explainer has clarified the incredible complexities behind this policy and leaves you eager to learn more about the intersection of macroeconomics and everyday housing. Thanks so much for exploring this topic with me.